ICICI Bank is all set to declare its Q2 FY22 results, and the growth at the outset looks quite strong. Net interest income is expected to go up 20% on a year-on-year basis and around 2.75% on a quarter-on-quarter basis to around 11,250 crores odd. PPOP, which is the pre-provisioning operating profit, is expected to grow up a strong 6% on a sequential basis and 14% on a year-on-year basis to around 9,400 crores plus. Slippages number is expected to come in at 6,000 crores with some additional restructuring in terms of around 1,500 odd crores in terms of restructuring as well to come in. Gross NPAs, which were at 5.6% in Q1 of FY22, are expected to come in at around 5.2% in Q2, a healthy uptick there. Net NPAs are expected to come down around by 10 basis points to around 1.3% versus the 1.2% number in Q1. The NIMs are expected to come in between the 3.9 to 4% mark, which is also quite steady and strong. And the PAT is expected to grow 20% on a year-on-year basis and 10% sequentially to around 5,100 crores odd. The deposits and advances are expected to grow quite healthily for the bank. Deposits are expected to grow around 15.5% plus 4% plus sequentially to around 9,65,000 crores, and advances are expected to grow to 7,65,000 crores, a 17% growth on a year-on-year basis and a 3.5% growth on a sequential basis. Moving on to what could be the key metrics to look out for from these results. Of course, ICICI Bank, as I did mention, is expected to clock industry-leading growth over the next few years. The credit growth is going to be led by ICICI Bank as per expectations. However, the key risk is with regard to the credit risk, especially credit given to large companies. Any defaults there could lead to chunky slippages, could lead to lots of NPAs as well. So that number and that commentary would need to be looked out for over the next few quarters. Also, their cards business has done relatively well over the last few quarters, and some commentary or some visibility around that may be looked out for by investors. Growth and NIMs are both expected to come in quite steady, as we did discuss, and some commentary around slippages as well as recoveries may help, because ICICI Bank is expected to clock in slightly lower slippages and slightly higher recoveries. So those kind of expectations have been set out on the whiteboard for the bank. Also, what will be really looked out for in terms of key management commentary is the uptick in growth, credit cost normalization, as well as certain asset quality or the overall asset quality outlook for the bank.